noite, pessoal. Boa noite. Boa noite. Tudo bem? Meu nome é Pedro, eu sou um sócio aqui da McKinsey em São Paulo, sou da turma do MBA de 2005 do INSEAD. Estive em Fontainebleau 3 semanas atrás na minha reunião de 20 anos, foi ótimo. E em nome do time da McKinsey, está aqui com a gente também a Heloísa.
Oi, gente.
A Heloísa é a líder da McKinsey no Brasil hoje e também é do INSEAD, de que ano mesmo?
Dezembro de 2007.
2007. E
com essa turma.
Estamos com a turma 2007 aqui em peso.
Gangue.
E também aqui da McKinsey está a Lígia também, que é de que ano mesmo, Lígia? 2017. Então, nós, em nome da McKinsey, um prazer enorme receber a todos aqui, o alumni do INSEAD, são sempre bem-vindos aqui, espero que aproveitem, fiquem à vontade todo o tempo aqui conosco. Professor Mihov, it's a pleasure to have you here. In the name of the McKinsey team, it's a great honor and privilege to have you speaking to us tonight. I'll hand it over to Uras, who's going to give a brief introduction in behalf of the association. And please feel welcome and have fun. All right.
Bom, eu sou Antônio Uras, sou presidente da Associação de Ex-Alunos do INSEAD no Brasil. É um super prazer estar com vocês. Vários membros da nossa diretoria, estamos aqui com algumas pessoas também que já participaram da associação aqui conosco. E é uma grande honra estar aqui. Agradeço aí o Pedro, a Heloísa aí pela hospitalidade, está sendo bárbara. E aí eu vou fazer como eu faço sempre, que eu vou passar por alguns eventos que a gente vai ter, quais são os seus próximos eventos, e aí eu vou apresentar o Ilian aí para vocês, tá? Então, o que a gente vai ter em setembro, né? Em setembro, a gente vai ter esse professor feio aqui, que é o grego, mas ele é o cara em AI do INSEAD. Tá? E aí, conforme uma provocação que o Alberto Camões tinha feito, né, que era, falou assim, cara, tá acontecendo um monte de coisa, estou vendo gente investindo em startups de AI, eu estou vendo um monte de cursos de AI, né, mas de fato, o que a gente como líder, né, o que a gente como INSEADer ou como líder em geral, né, o que a gente deveria estar fazendo agora para daqui a 2 anos, 3 anos, 5 anos, ninguém sabe exatamente quando que isso vai explodir e deveria estar fazendo agora. Então, a ideia é a gente aproveitar o Global INSEAD Day, que é 12 de setembro, talvez não seja no dia 12, vai ser dia 12 e 27, né? A gente falar assim de, cara, o que eu tenho que aprender, o que eu tenho que urgentemente saber para estar navegando aí nesse novo mundo, tá? Vamos ter no dia 17 o nosso Singles Mingles, de novo. Esse Singles Mingle é um evento interessante, foi um sucesso ano passado, que é juntar solteiras, solteiros do INSEAD, ou próximos, né, para se conhecerem, para eventualmente formarem aí duplas, né? A gente sabe que está cheio de couples, né, de INSEAD, né? E a gente tem um caso de sucesso no ano passado que o casamento aconteceu esse ano, tá?
Mentira!
Saiu desse evento?
Saiu
desse evento?
Resultados impressos. E agora eu vou falar um pouquinho do evento que a gente vai ter hoje, que a gente vai discutir a taxa natural de juros, né? Então, a gente tem a taxa nominal de juros, a gente tem a estimativa de inflação, e algo que a gente chama de taxa real de juros, tá? Essa taxa real de juros, ela converge para um número que é a taxa natural, porque essa taxa, ela é o intervalo. Quando está acima desse intervalo, você força as pessoas a investir. Quando está abaixo desse intervalo, você força as pessoas a gastar, porque é melhor gastar agora do que guardar para comprar depois, tá? E quem vai falar sobre isso com a gente é o Ilian Mihov, que se tornou aí um amigo aí com o passar do tempo, né? Ele é casado com uma MBA do INSEAD, com a Cíntia, que é 07D, a gente falou de vários 07Ds que estão aqui em peso, a Cíntia vai chegar aqui depois, ela está num compromisso aí com o Booking, né? Mas o Ilian, ele é professor do INSEAD, né? Ele é Rousing Chair, né? Ele tem essa cadeira da Rousing, que é a família dona da Tetra Pak. Ele estava num sabático, desde que ele deixou de ser reitor. Ele foi reitor do INSEAD por 10 anos, 2013 a 2023. Aí ficou num sabático até agora, que termina. Aí ele vai agora em agosto para Singapura, vai voltar a dar aula lá, né? E ele é um PhD em economia que estudou com ninguém nada menos que o Ben Bernanke, lá em Princeton. Tá? Então, ele vai falar para a gente que isso é um tópico de pesquisa. Tem outros dois tópicos, né, que são Neuroeconomics, que a gente não vai falar hoje, mas eu quero falar um dia de Neuroeconomics. Tá? E tem outro tópico de pesquisa dele, que é a questão de tarifas, mas está todo meio de saco cheio de tarifas, então a gente não vai falar.
Obrigada.
Ele também pediu licença, ele falou assim, puxa, o evento vai ser gravado, então eu tenho que avisar vocês que a gente está gravando o evento. Então, participando aqui significa dando direitos aí de imagem e de som, né? E ele falou assim, bom, já que está sendo gravado, eu não posso falar tão mal do Trump. Eu falei assim, cara, para falar mal do Trump, todo mundo aqui pode falar, então isso sendo causado, tá? Então, Ilian, let me... I have not told any lie, I promise.
Well,
I know you have not understood.
I don't think we were laughing.
No. So, we switch the presentation. It will be the same or be yours, right?
Okay, well, thank you very much. Thank you for this wonderful introduction, of which I did not understand anything. But I hope that it was good enough, so people did not walk out. So first of all, I want to thank McKinsey for hosting us here. It's a really beautiful place. I'm very thrilled to be back in Brazil. I've been here twice before this time for INSEAD events. Probably most of you know, and maybe Antonio mentioned, that I used to be Dean of INSEAD for 10 years. And as a Dean, I visited a lot of countries, including Sao Paulo twice. Actually, Sao Paulo was one of the first places that I visited as a Dean in 2014. We had a big event here for the Alumni Association, the International Alumni Association. Now, now I'm on sabbatical. I spent 2 years in the United States. I'm going back to INSEAD in September in Singapore. And I'm here because my wife is on a business trip in Sao Paulo, so I decided to come with her. Then Antonio said, but if you're here, why don't you give a talk about something? And I said, sure, I will do that, especially because you have to know this, because I started teaching in INSEAD in 1997. So he was in the first promotion that I taught, and I feel so bad about that. So every time they ask me to give a lecture, I give a lecture. In fact, for their reunion in 2017, I said, look, I'll give you a free lecture just to redeem myself. And then in 2022, we did the second one for their another reunion, which was such a fun, so much fun. Both of them actually were great. So today I'll be talking about the natural rate of interest. I would, of course, encourage you to ask questions if you have any questions, because it is a little bit more technical topic than the usual topics that I talk about. As I understood, Antonio mentioned about tariffs. So I said, I can talk about tariffs, that people are sick and tired of hearing about tariffs. I usually like talking about economic growth. So I have a lecture about economic growth and the middle income trap and so on. But I think that I already did it once in Brazil. So I felt like, let's do something else. So Antonio suggested this natural rate of interest. Now, I put an article on LinkedIn, like 3-4 pages, explaining a little bit of this R star, which was part one of 2 parts. It was written, I think, in November 2023, with the great intention to write the next one a month later, but it's not written yet. However, you'll hear it here, and actually it will be an incentive for me to sit down and write part of this thing. As I said, please feel free to ask questions and stop me. Let's make it a bit more interactive. We do have a Q&A session at the end. Before I dive into the natural rate of interest and explain what it is, I just wanted to give you my perspective of what are the big things out there that basically change macroeconomic dynamics. And the first one, I would say, still the biggest force of all forces is convergence, is the growth of emerging markets, developing countries converging to the rich ones. Most of this growth is happening in Asia, but also we see now pockets of Africa and Latin America also growing faster as predicted by this convergence thing. We can discuss it during the Q&A. The second thing, which I really think is determining a lot of things that we observed, is this decline in the real interest rate that we will discuss today. So this is the topic for today. Government finances, the rise of debt all over the world is a big topic that I will touch upon today a little bit, but not too much. Trade wars and the changing role of the US dollar. It's a very interesting topic as well, because people do not understand what is driving current account deficits. The advisors, the main advisors to President Trump do not understand, even though they have a PhD from Harvard University. And telling them, understanding what is driving the current account deficit and thinking that the exchange rate is going to change the current account deficit is just the worst possible economics you can have. But again, that's a different topic for different time when I come there. If you invite me again after this lecture, we can talk about that. Geopolitics, geoeconomics, the decline of democracy around the world, to me is also a very big topic. Geopolitics is an obvious with all these wars around the world. AI, you'll have tales talking about artificial intelligence, but of course it has macroeconomic implications. I used to put my seventh one, sustainability. I don't know why I switched to demographics, but I want to keep them seven. But I would say sustainability and sustainable finance is also a big thing, and maybe we'll discuss it as well. But keep in mind that to me, these are the big issues, the big trends out there. So let's dive into this. We're supposed to start at 7:37. We're starting a little bit late, but I still hope that I'll finish on time. So everybody knows what the nominal interest rate is, the interest rate that banks charge, which I will be denoting by I. So when you see I, it is the interest rate that you receive on the money that you deposit, or you have to pay on the loan that you take. The nominal interest rate, however, is very misleading for economic decisions. Because what you care about in economics, for your economic decisions, sorry, so Siri asking me to define economics now. Go ahead. I don't know how. I was trying to deactivate Siri. I don't know how.
That's a difficult question.
So, what we care about is your consumption of goods and services and your wealth in terms of real stuff and not nominal things. So we define then the real interest rate as the difference between nominal and inflation. And here is a very simple example. Suppose that the nominal rate is 5%, inflation is 2%, then the real rate is 3%. What does it say? It says that if I save my money today, next year I'll be able to buy 3% more goods. I'll have 5% more money, but because price will be higher, then I will be able to buy only 3% more goods.
But these are reference numbers for normal countries, right?
Well, okay, so let's suppose.
What are normal countries?
Suppose the interest rate is 20%, but inflation is 30%. You're receiving a lot of money, but then next year you'll have 10% less purchasing power. Now, this is absolutely important to understand these definitions, because otherwise we're going nowhere. So let me ask you this question. In the first case scenario, will you save or will you buy? Save. In the second case, buy today. Now, this is very important when we go to monetary policy, because you will see that if the central bank sets interest rates at the wrong place, then inflation becomes self-fulfilling and accelerating. If interest rates are too low, people start borrowing, consuming more, because they say, okay, now the prices next year will be more, so let's buy today. But if you buy today, then you increase inflation, and then high inflation makes you to buy even more today, and then inflation becomes a vicious cycle. So everybody understands this. The real interest rate shows your return in terms of goods and services. If the interest rate is positive, then you consume. Here are some examples, again, how misleading the nominal rate can be. In Japan, interest rates used to be 4%, then they went down to 0. But actually, in real terms, when interest rates were 4%, your real return was lower than when they were 0, because there was deflation. So if you just keep your money, next year things will be cheaper. And here is monthly data for the US. Again, with high interest rates, you can have lower nominal real return. Okay, so it is, and in fact, this second episode generated the recent increase in inflation in the US exactly because the real interest rate was too low. So the US inflation continued to increase until the Fed raised interest rates so much. So today, the topic of our talk today is basically this graph. Again, this is the real interest rate in 12 advanced economies. Again, just to keep the formulas here, I will use these letters: R for real interest rate, I for nominal, and Phi for inflation. So this is 12 advanced economies from 1991 until today. You can see the real rate was about 5–6%. It has been going down until 2023 became negative. Okay. So we have to understand this trend because it implies so many things about financial markets, about policy, about where economies are heading. The first thing to understand is what determines the real interest rate. So the real interest rate is not determined by the central bank. That's lesson number one. Central banks can affect it temporarily, but first, these are long-term interest rates. So they're like 10-year bonds. But second, they can, if they keep inflation too low, if they keep interest rates too low, then there'll be inflation and the real interest rate will adjust. So let's see now what determines the real interest rate. And here is our favorite chart of supply and demand. So there's nothing more than this here. On the horizontal axis, we have saving and investment, which is saving is the supply of fund, investment is the demand for funds. On the vertical axis, we put the real interest rate. Saving is upward sloping because we assume that when interest rates are higher, people will save more. So with high interest rate, you save more. Investment is downward sloping because when interest rates are very high, very few projects will generate net present value under these interest rates, positive net present value. So you have very little investment. Okay, and then if interest rates are low, and when they cross, we determine the real interest rate R star, and this is our topic today. So question number one: what determines how much we save besides the real interest rate? If you remember your microeconomic classes, whatever is not on the chart is a shifter. So what will increase the savings rate if it changes? What are the key variables? GDP. The first and the most important one is GDP, or same as income. If you're very poor, you can't save much. If you're very rich, you can save a lot. As your income grows, you save more and more, which means that if income all of a sudden increase in the country, the savings curve will go to the right and the interest rate will drop. Okay, so that's again, supply and demand. Just supply of funds increases. I mean, if you think about this logically, there's just more liquidity out there, more funds, then the interest rates will be lower. What else will determine the savings rate?
The fiscal policy?
Fiscal policy. So that's a great point, because here when I say savings, it actually consists of two savings: the private saving and the public saving or the government saving. Okay, so what do we call the government saving in our everyday language?
Taxes.
Well, taxes are one side of it. It's private. Is the budget.
Yeah.
Is the budget surplus or usually deficit is the saving of the government.
Yes.
It's very rare, surplus. So if the government starts saving more, interest rates will go down. If they start saving less, and we'll discuss it, interest rates will increase because the saving curve will shift to the left. So the government, what else? There is another very important determinant. Productivity will determine mostly investment. So productivity matters, but it will be shifting the demand for capital. If I become more productive, I can make more money if I get more people and more capital to work. So productivity will be a shifter of the investment. Okay. The other thing that matters is the expected future income. If you expect that next year you'll get a promotion and you'll be paid $10 million, then you don't have to save today. Right? You'll say, next year I'll be so much richer, then I don't need to save today. And the final one that I want to mention, because it explains so much the financial crisis of 2007 and 8 is the wealth. So if you're very wealthy, out of your income, you don't have to save. So suppose that you have 10 billion in assets out there, but you still work and you make like 500,000. Because you have so much money out there, you don't have to save. As your wealth increases, your saving rate goes down. Normally, that's what people. The opposite is true. If this is a little bit harder to comprehend, think about this. All of a sudden, all your wealth is gone. Then out of your income, you have to start saving more. This was the key factor in the financial crisis of 2007 and 8, because the American households felt so wealthy because of the housing boom. Prices were increasing 10, 15, 20% a year. They felt that they're so rich that they don't need to save. They actually were consuming too much, generated the current account deficit and so on. But that's not the topic for today. So here, in order to explain why we have this chart here, obviously, we have to figure out what shifted the savings curve to the right, or the investment to the left, down. So that actually the interest rate has gone down. One of these two things must have happened. And the reason we want to know what is happening is because we want to make predictions about the future. Will these forces that are shifting these curves stay in place, or will they be gone? Because as you will see, has huge implications. So sometimes when I show this chart, people say, but what, not this chart, the previous one, people say, but wait a second, this is only like 30 years of data, right? So the trend is down, but they go down, they go up, interest rates can go anywhere. So here is data for 800 years. I call it, that's more convincing. So these bars are the century averages. So that's the 14th century, 15, 16, 17, and so on. And you can see the decline from about 1500s onwards, the decline from roughly 11. Again, we're talking about the real interest rate. 11, 8, 5, 3.5, and sorry, the real rate is here. 6, 4.6, 3.5, 3.4, 2, today 0. So this thing has been going down for centuries, not from the last 20, 30 years. Now, knowing what shifts the savings curve, why do you think that happened? A couple of other things that we can discuss. Why do you think this is happening? I mean, again, there are many hypotheses, but one is the simplest one.
Income increases.
Income increases. So the growth, especially after here, you know, those of you who have seen my growth charts, I show this chart from year one until 1800, there is no growth. And then all of a sudden growth goes crazy. So all of these generating higher income, increasing savings rate and so on. So the facts are very clear. So we have to ask now, what caused this savings glut, as my advisor Ben Bernanke called it in 2005, that interest rates are low because of all this increase in savings around the world? And the answer is that there are several different explanations. The biggest one is China. China has been growing over the last 40 years. China is not only big, but people in China save a lot. So the savings rate in advanced economies is about 20%. So in most advanced economies, people, meaning corporations and households together, save about 20% of GDP, of their income. In China, 40, 45, 50%. So as China becomes bigger and bigger, they just pour in the world economy more and more money. And that depresses the interest rate. Demographics, you know that there is this population boom that happened after the Second World War. Now people that are getting into in the workforce today, some of the baby boomers are retiring, but they realize you work from the age of, let's say, 25 until 65, 40 years. You have to support life over 90 years. Most advanced economies, people are expected to live 90 years. So you need a lot of money for that. So one might say, but aren't the retirees actually doing the opposite? It's true that once you retire, you start saving, but there's still much fewer than the people that are saving. And that will stay at least for the next 10, 15 years. And so on. And at the same time, investment has not been growing as fast, and I'll show you some other data. So here is actually a very interesting chart about the world savings rate. So as percentage of the world GDP. In 1992, the world was saving about 23% of its income. 20% of this 23% or 18% was coming from the advanced economies. I mean, notice this thing. Advanced economies were basically responsible for about 80 to 90% of the world savings. Then things started changing, and today you can see that China alone is not saving as much as the advanced economies, about maybe 60% of what advanced economies are saving. Okay. And you can see the increase in this overall saving. And again, this is just the percentage. But with the percentage of GDP, as GDP is increasing, the whole flood of money is increasing. Think about this in the other way. If only the advanced economies were determining how much savings there will be, today actually will be facing the opposite problem if there was no China. We'll be facing actually people with high interest rates because the saving rates have been declining.
Yes. How does government deficit talks to world saving increasing? I mean, like you see a lot of economies having like growing deficit in the government side, not in the public market. But how do you correlate with that?
So part of the saving that the households are doing go to buy the government debt. So at the end of the day, the government debt is bought by individuals. I mean, through pension funds, through mutual funds, and so on. So basically, they finance this government budget deficit and the private investment. And as you will see, a big part of the government saving or government deficits in the United States are financed by China, okay, which has implications in this trade war. And I think that's why President Trump backed down when all of a sudden he imposed 28%, then 50, then 80, then 145% in Chinese goods. And then the bond market just collapsed because they know that if there's a war between China and the US, the Chinese are not going to buy US treasuries. Actually, they reduced their buying in 2018 during the first Trump administration, but they're still a big buyer. I have a chart. So this is well established. Here, two economists from the Bank of England actually decided to say, let's try to figure out how much exactly of this collapse in the interest rate that we've seen is due to different factors. So the collapse was about from here 1980 to 2015 was about 5 percentage points. So they say out of these 5 percentage points, the biggest one is demographics. The second biggest one is growth. And then there are inequality. Inequality matters because rich people save much more than poor people. As inequality is increasing, saving is actually increasing. So, I mean, how many humongous boats can Tesla buy? So at the end of the day, it's going back to saving. And then the relative price of capital is basically saying that capital became very cheap. So machines have become much cheaper than they used to be relative to other goods. But overall, we can find explanations of why interest rates are going down, and it is basically due to the decline in the decline in investment and increase in savings. So why does it matter at the end of the day? We accept the fact that the equilibrium interest rate determined by all of the world's savings and all of the world investment has been going down. The first thing that it matters for is monetary policy. So how do we conduct monetary policy? Well, it's very simple actually. It's not too complicated. They try to make it sound too complicated. If the economy is cruising, it's not too hot, it's not too cold, there is no inflation, unemployment is not high. So basically, we think that it is in equilibrium. Then the federal funds rate or the interest rate of the central bank should be equal to R star, it's capital R, because it's the real rate plus the target inflation. So that's kind of like a nominal rate. Sorry, Dan. So we set it equal to what is the equilibrium one plus inflation. If the equilibrium one is 1%, so you go and you check it out there, it's 1%, you have 2% target of inflation, then in normal times it should be 3%. But as we know, sometimes things are not so great. So if the economy is in trouble, inflation is increasing, or unemployment is too high, then the central bank will apply it, on the pedal of acceleration or braking. What are the accelerators and the brake? This is the formula from John Taylor from Stanford University, who basically said the accelerator and the brake is determined by where is inflation relative to the target. So the gap, if inflation is too high, then I will multiply the inflation difference between the current inflation and target by 1.5, and that will increase the interest rate target. Or the output gap, which is where is output relative to its normal level of output, which we call potential. If you're producing too much, we know that this is a sign that inflation will come, because companies are working their workers overtime, they have capacity utilization that is very high, and eventually they realize we should just raise prices instead of working so hard. If output gap is negative, then you lower interest rates. So that's that was designed by John Taylor in 1993. It's a very simple formula. You just plug in. So this is given. So this is given. Here, the inflation target is given. So you just look at the inflation, you look at the output, plug them in, and say this is what the interest rate should be. So monetary policy is super easy. Just look at this. I'm not joking. It is true. So I don't know how many of you remember Alan Greenspan, who's the chairman of the Fed, from 1987, I think, until 2005. And look, the Taylor rule, you know, anybody can do it with literally like maybe 5th grade education. You know, the Taylor rule, the blue line says lower interest rates, make them high because inflation increased. Then there was a recession, lower them. Inflation started coming up, increased and kept them constant. Dot-com bubble burst, increased. And Alan Greenspan just increases, decreases. So he's not a very smart guy. You just have to follow these things. And they were always saying Alan Greenspan is the god. He's the master of monetary policy. And he was just following this simple formula. Then the crisis happened, and the Taylor rule said you have to have negative interest rates, but the nominal rate cannot be negative. Well, Europeans showed that it can be. It's not a good thing to have negative rates. So the Fed kept them at 0 and they started quantifying. I mean, the interest rate is the price. You change the price up and down to manage the economy. Once the price hits 0 and you cannot lower it, then you work on the quantity. Just increase the quantity of money. Then, you know, it started increasing. And here you can see very clearly the big mistake of Jay Powell. The Taylor rule says increase interest rates because inflation went to 3.3%. That's basically April 2021. Said, no, it's a transitory inflation. Increase them, no, it will go away. Supply shocks, whatever, increase them. So basically, for the first time in the history of this rule, we had a gap of about 3 percentage points. The Taylor rule says interest rate should be at least 3 or 4%, and they were at 0. And then, as we said, what happens when interest rates are too low? Inflation, and inflation starts accelerating because people start buying more and more because it's very cheap to borrow and prices are increasing already. And then one day they woke up and they said, that's wrong. Let's actually do it right. And they increase interest rates. So why the natural rate here is relevant for monetary policy making? Because the natural rate is, the central bank rate is the natural rate of interest plus the inflation target plus 1.5 inflation gap plus 0.5 output gap. What number you put here, whether you put 2%, which when I started economics, we were told that the natural rate of interest was 2%, which was the average in the 20th century, or whether you put 1%, or whether you put 0.5%, makes a huge difference. You basically can miss the train if you don't put the right one. Here, a lot of people were criticizing the Fed for keeping interest rates too low. But it's too low because this rate has been going down. And basically they could not restart the economy going. And the gap was negative and so on. But knowing where, if you ask me what the Fed is worried about most these days, it's actually one of the things is trying to find this R star so that you can say you're not too high, not too low because of this. Okay? So that's why it matters for monetary policy. And as we saw, it has been going down towards 0. Why does it matter, this interest rate? The second thing is fiscal policy. So here is government debt in 22 economies, advanced economies. I mean, this is really unprecedented what we see today. The data from the 1800s until 2005, I think, or 10, is from Carmen Reinhardt and Ken Rogo from their book. This time it's different, which of course it isn't. And then the IMF. So for the first time in the history of the world, we will end up in these countries with higher debt without any war. Now there is a war, but these countries are not in war. Because here the debt increase are the Napoleonic Wars. The Brits and the French were issuing debt like crazy in order to finance these wars, much more than what they could afford at the time. This, of course, is the Second World War again. So in wars, you get this spike in debt. And then something started happening in the 80s. And then the economy started piling more and more debt. And today we see 125% debt to GDP ratio in advanced economies. Now, this is an issue because demographics make deficits bigger, because more and more old people live longer and longer, and they, in most countries, take money from the government. In the United States, just if you want to hear a scary number, I can give you one. I don't know how many of you know about Madoff's Ponzi scheme. You've heard about this, right? So actually, the documentary is amazing. If you haven't watched it, watch it. Bernie Madoff created the Ponzi scheme for $50 billion. Basically stole $50 billion. The Social Security Fund in the United States is a Ponzi scheme for $50 trillion. It is a Ponzi scheme. Because basically the way that it works in most countries, so I don't know Brazil, but I bet it's the same way. So the current workers contribute to the Social Security, but it's not saved. It actually goes to pay to the retirees. And you have bigger and bigger obligations. And at some point, of course, you have to go and figure out how to reduce these benefits, go bankrupt or inflate them away. But inflation does not work so well in this case, because in most cases, Social Security payments are indexed to inflation. So that's not an easy way out. Demographics is making it bigger. Deficits are running like crazy. Interest rates are increasing. Slowdown in China is eliminating one of the big bars of debt. The Fed used to buy a lot of debt. Climate change, wars, and all these things will make all of this worse. And here is the chart that I was mentioning before. If we look at the US, about 30 trillion of debt. Now it's 33 by now, probably. The biggest part is held by the government institutions. The Federal Reserve, I think it used to have like 4 trillion of this debt. But also the Social Security Trust Fund has some money. But you can see here the increase in the orange area, which are foreign governments, or central banks mostly. The biggest holder today is Japan. And the second biggest is China. Now, how these changes will determine the interest rate. If this orange part starts getting smaller and smaller because of trade wars and because of all these things, then there'll be collapsing prices of bonds and so on. But also, of course, the US government is trying to use their negotiations also to negotiate this. One of the advisors to the president was saying, we will force foreigners to buy 100-year bonds. No coupon payment. Again, this is a very serious person. So I decided, okay, let me do a calculation of this. If you say, okay, but I want a return of 5%, right? 100-year bond, no coupon payment. What will be a price about, let's say, $1,000 bond?
100,000.
No, it will be like, like, I don't know, $70. So you generate a liability of millions, billions, and so on, but you'll receive today much less than that. And of course, nobody's going to buy this thing because in 100 years, I don't think you're getting any money back. So anyway, but again, the ownership of this government debt is very important. So how do we deal with the increase in this debt? And again, this is topic number 3 of my big trends, but it's relevant here for the interest rate as well. This is the US debt. Here you can see the Civil War, World War I, II. Again, today they have more debt than during the wars. So how do you resolve the increasing debt, which is true also for Brazil, not only for the United States? Cut spending usually doesn't work. In the United States, actually, that's another scary fact. 95% of the revenue, whatever they collect, goes to non-discretionary spending.
Brazil the same.
The same here, yeah.
Most markets.
So forget about cutting spending.
Most markets are the same.
Raise taxes. Now, taxes in most countries are, I think, abnormally high. And people spend so much time to figure out how to avoid taxes or evade them. And of course, in the US, nobody's talking about raising taxes.
But this is what Brazil is doing, raising taxes.
And again, there is a limit. I don't know exactly what the tax is here. What is the highest marginal tax rate? Income tax?
Wow, 27.
Well, it's
But we tax
GDP
products and services a lot,
so VAT.
not income.
Yeah, VAT.
Yeah, it's because it's easier to collect. That's why VAT is so popular. Then the other thing that matters again for this debt is not debt itself. Oops. I think it's we're running out of battery very quickly. So what matters is debt to GDP, right? Because you're repaying your debt out of your taxes, which is the percentage of GDP. If GDP is very big, you don't have any problem with that. But if it is small, then you have an issue.
Professor, how can you put Argentina as a reference in that scenario that you're describing? Because Javier Milei apparently has worked wonders with the Argentinian economy and took it out of a very big hole to a hole as a reference.
Small one. So the base is my understanding from what I've read about Milei is that actually some of these non-discretionary spending, which means you have to go through the Congress. It's not that you cannot remove it, but you have to go and you have to vote new laws and so on. You cut this kind of spending. Because what happened in Europe and then eventually also in Latin America is that people saw, in Europe in particular, they saw very high growth and people started saying, oh, you know what? We need to distribute this more. They created the welfare state. At some point, it's not sustainable. It's great, to give money away, but if you have them, if you don't. So I think that's what Milei is doing.
And there's a component, and I've been following it from afar, so I cannot claim it to be 100% true. But there's a claim that he hasn't issued, the Central Bank of Argentina hasn't issued any money for the government, and he hasn't been printing money as in real. And that is one of the aspects. Well, one of the success that they described has happened.
But that's rule number 1. But there are a lot of governments that do not resort to the central bank printing money and still have issues, because fundamentally you still have to find a way to fund your deficit. And if you don't cut your spending, you can go issue bonds, but also there is a limit to that.
For sure. Thank you.
So the as I said, the thing that matters is debt to GDP, because if GDP is big, then it's easy to repay. So today, when you listen to a lot of politicians talking, they say, you know what, we'll just grow GDP. Growth will be very high, and therefore we can afford higher debt. But again, those of you who have seen my lectures, there is a speed limit in advanced economies of how much GDP can grow, 1.8% income per capita. It cannot grow faster than that in the long term.
But that's how England paid for the Napoleonic Wars, right? They grew the economy in the 19th century.
So the economy grew. I think, again, in many countries, there was a devaluation. So they started, changing the amount of gold in the metal, in the coins, the denomination here. So actually, I was at the conference recently. Somebody was presenting fiscal policy and so on. So she said, can you guess how we managed to get here from 110% or so down to 25%?
Default.
No, the US did not default. Inflation. Inflation has been the best. Inflation is the same thing as changing the denomination of money. So instead of saying that you put 1 ounce of gold, you have half an ounce of gold, but you still call it $10. So, and that's the same thing as inflation. So inflation is very useful because it grows the denominator. Because GDP is nominal GDP, and it grows with the rate of inflation and the real growth. Low interest rates very unlikely, so inflation, we talked about this, but inflation works only up to a point. Because one day people wake up and say, you know what? Inflation is 10%, you're issuing bonds that give me 5%, I'm not going to buy them until interest rates go up above 10%. So you can work out with surprise inflation, which actually here worked out. You see the governments in all advanced economies were issuing bonds and borrowing like crazy. But debt to GDP ratio went down here, not because of real growth, but because of inflation, 2022, 22, 23. I mean, it looks like a small thing, but it's still important that during these times. And the other thing, so these are all the 7, I don't know of any other way of dealing with that. Financial repression, I'll talk about this because it is important for interest rates. Financial repression is basically having regulation that forces banks, financial institutions, insurance companies to hold debt. So that has been practiced also a lot. And then default on that, which is not a good outcome. So here is the dynamics of debt to GDP. Actually, no, maybe I'll skip this thing. I'll just go very quickly. So if you think of debt to GDP as this column, it can go up if you have a deficit or if interest rates are high. It can go down if you have a surplus or economic growth. So I can calculate, okay, let's not try to reduce that to GDP ratio. Let's just stabilize. How much, what kind of surplus or deficit should I have in order to keep debt to GDP constant? And here is a very simple formula, the primary balance. Primary balance is the balance of the budget balance excluding interest payments. So the primary balance to keep debt to GDP constant has to be the ratio and the interest rate minus the growth rate. So here's the one calculation. In 2023, the real interest rate was 1%, growth, real growth 2.4%, that's 120%. The required primary balance of the United States to keep debt to GDP constant was negative 1.68%. In other words, you can run a deficit and still it does not increase that because the interest rate is so low. Think about this. Remember the chart I showed you that is going down. Think about this number not being 1%, but being 3%. Then you have to run a surplus. Then we're running a humongous deficit. So this cylinder will be just exploding. So the real interest rate that we saw going down gives a lot of space to fiscal policy. They actually can run deficits and still not explode the economy. Here are several countries, including Brazil. So I think in 2023, so the overall balance is the sum of these two columns. Oh, actually, the difference because this is the interest payment. So minus 1.9, minus 6.0, minus 7.9. This is the total debt. nominal interest rate, nominal growth. Again, you can plug it in the formula and you can say, well, your required primary balance is 1.1 plus, it was negative 1.9, so that is increasing.
Yeah, nominal rates are higher than that now.
Yeah, so that's 2020.
Yeah, way higher, unfortunately.
Yeah. The US, again, 2.3 in this calculation, it was 5.8. And so on. So at the end of the day, most of the countries that you see around the world, except India, for one reason or another, India has been running smaller deficit than is required, and therefore the debt has been going down in Japan as well. But everybody else, this column is much higher than that, meaning that debt to GDP ratio has been increasing. Now, as I said, the decline in the interest rate in the world has been a big boost for fiscal policy. But it might be over, because you can see here the interest payments as a percentage of GDP in the US. Since 2021, this has been increasing. I mean, I did this calculation before, so they're paying about 4%, so about 1.4 trillion dollars every year go to paying interest in the United States today, on a deficit of about 2-3 trillion. So why does it matter? The final thing. So monetary policy, we covered fiscal policy. This is the final thing. Stock markets. Everybody wants to know what's happening in the stock market. Nobody knows. So basically the upshot, the final conclusion of this part here will be where the stock market is overvalued. We won't evolve it, right? Now, actually, let me show you. The next graph has the same chart, but it's a bit easier to read. So here is the price earnings ratio designed by Robert Shiller, who is a professor at Yale University. It's cyclically adjusted because if you look at earnings, they go up and down. So you have to smooth them a little bit. So that's what he's done here. This is the price of S&P 500 relative to the earnings of the 500 companies in S&P 500, right? From 1880 until today. So literally, I just downloaded this yesterday. So the mean, the average of the price earnings ratio is about 17.27. The current is 38.8. Which means prices are almost 2 times higher than what they have been on average. So the stock market, according to this metric, is overvalued. But if you look a little bit closer at this chart, it's actually drawing a straight line, which is the average, is probably not the right thing to do. Because if you ask me, to me, it looks more like that. So for about a century, sometimes it's higher, but then it goes down. Here is the pre-1929 stock market boom. October 1929 collapse. Here is the dot-com bubble collapse, and so on. So why do I draw it like this? Actually, if you do regressions, this basically says that since 1980s, the equilibrium price earning ratio, the one to which the stock market should be going, has been increasing. Why? Well, let's put one formula, very simple one. You know this, that one way to think about the price of a stock is the present discounted value of future dividends. Okay? Now you discount at some interest rate, which has a risk-free rate and a risk premium. So one way to think about this increasing in the equilibrium price earnings ratio is to say that the discount rate has been going down. When the discount rate is lower, let's say it's 0, right? if R is 0, then the price is the sum of all future dividends, which are infinite, so the price should be infinite. If you discount it 0. I mean, basically the money today and the money 10 years from now and 100 years from now are worth the same. So you just add them. If the interest rates are very high, then future earnings matter much less than today's earnings. So that's what this is doing. But again, there is a component when you're discounting, you're comparing to the risk-free rate, and then there's a risk premium from the fact that you're investing in the stock market. So what is happening to this R over the last 100 years? So the blue line basically says from 1880s until now, this is R, this is the rate at which we're discounting things. Again, it's calculated using actual observations and so on. It has been going down. So people had an expected return of about 8%, 9% a century ago. Expected return meaning that this is the discount rate I'll be using. And then you can see this collapse since 1960s first, but then since 1980s, complete collapse. Today, the expectations are about 4%. So, I mean, again, this is real because sometimes people think, but wait a second, I expect the market to give me 6, 7%. That's nominal. It's only real. So if you want to add inflation to this, you get the nominal discount rate. Now, 3 economists from the European Central Bank actually used some fancy econometric methods to say, what is it, where is it coming from? Is it coming from this collapse, from the fact that the risk premium has gone down, meaning that people now view the stock market as much less risky than it used to be? Or is it the risk-free rate? One of these two things have to collapse. And as you can see, the red line is actually the risk premium. Oops, sorry. The red line is the risk premium. So if the red line is the risk premium, the difference between the blue and the red line is the risk-free rate. This is more or less the same chart that I was showing you before, the collapse of the R star. 80% of the decline in the expected return is because the risk-free rate has gone down. What does it mean for our valuations? Well, I decided, let me do the following calculation. So the dividends are the payout ratio. You decide to pay out, let's say, 30% of your earnings times earnings. 30% of the earnings next period and so on. Let's suppose that earnings are growing at rate G. I can use a bit of mathematics, get earnings on the other side, sum all these things, and basically get a very simple formula. The price earnings ratio is the payout divided by R minus G. R is the discount rate, G is the growth of earnings. So I can go then and look at the data from Bob Schiller's website. You can get all this data, you can do the calculation yourself. The historical average is 17.5, so I can plug in here 17.5. 61% here, 0.61. I can calculate the average real earnings growth, 1.9%. And from this, I can figure out what people were expecting as a return, 5.4%. If you look at this chart, in fact, roughly the blue line has an average of about here. Oops. Sorry, about here, about 5.4%. But that's not the right way to continue calculating things, because you can see that the blue line here and here are very different. So if I want to have a more precise calculation of what should be the price earnings ratio, so I can ask the question, what if R is not 5.4, but it's actually what these guys have calculated to be 4%. So if I use just the numbers that are here in the last 25 years, 4% minus 1.9. So assuming that earnings will continue, 60% payout ratio, plug in the numbers. The equilibrium price earnings ratio now will be 29.7. What does it mean? In my view, the stock market is still overvalued, but not by twice as much. So this number, again, don't take it literally 29.17, but somewhere closer to 30 rather than closer to 17. So there could be still a collapse of the stock market, but it will be like 10, 15%, maybe 20% correction, not 70% correction. So that's, so I would expect, if you ask me, what would you expect to see in the future? I would expect that this thing will be fluctuating around here from this point onwards. Okay, and then the big question we ask is, will R star, the risk-free rate, remain low? Because if it remains low, this is your benchmark for overvaluation and undervaluation. If it does not remain low, if it increases, maybe this is your benchmark. And the same thing is for monetary policy and fiscal policy. So let's then ask that question. What is will this decline in R star be reversed soon? Again, this is now data up to today, literally, of the 10-year real interest rate in the US, which is, again, one of the measures of R star that we do. You can see this collapse here again. As you can see, in recent years, it has increased, and instead of being closer to 0, it's now closer to 2%. So what are the arguments that it is reversing? So it is going back. Then you go back to the 3 lessons about interest rates, and then you can figure out how to adjust them. The first argument in favor of reversal of the extensive government deficits in advanced economies. Because remember, the savings curve with more deficits is shifting up. Okay? As deficits increase, so that will lead to an interest rate. Let me just show it here, even though I'm sure that everybody can imagine this. So it goes up from here, and then it goes up, then interest rates will increase. The second thing is that at historical highs may lead to rise in the risk premium. So today we assume that there is no risk premium in US government debt. Basically, we assume that they will never default. But once you start running deficits of debt of 150% of GDP, and with all the social security things coming in, the way we start calculating R star might be wrong, because then there is also risk premium. The next thing is investment needs due to AI sustainability, infrastructure development in many countries around the world basically say that investment will also increase. So we have now the first 2 lines are saying, we're moving from here to here. Now with investment needs, we move also further up. So from here to here and then up to here. Deglobalization, I think that's actually a big issue as well, and financial markets fragmentation. If foreigners don't want to buy US debt, then you'll end up with high interest rates. So to me, these are the main arguments, a couple of others for the reversal. However, there are arguments for the suppressed declining R star. Remember that growth is still out there in emerging and developing countries, especially in Southeast Asia and China. Demographic trends are still in favor of savings, and these are very powerful things. Inequality is increasing, so all of these things are saying the savings curve will still be pushing down. And financial repression, financial innovation, stable coins. The stable coins, the new genius act, as they called it. And Trump said that it was named after him. Is basically for the stable coins are required to hold safe assets, which US government bonds are safe assets. So now all of a sudden there is a huge new demand for bonds.
Shouldn't AI also play a role in increasing productivity than income somehow?
Yeah, so if AI increases productivity, which again is a need, if AI increases productivity, then growth will increase, and then of course we'll see lower interest rates. But so far, when you look at the data, we have not seen this productivity increase. It's too early. So you know that very often industrial revolutions in the beginning do not create the productivity increase, but eventually they do. So let me summarize, then we can have some questions. I mean, again, I think that this is a very important topic that is very rarely discussed. So I have to thank Antonio for pushing me in that direction, because I really want to make sure that people understand that these things are not random out there. The monetary policy, interest rates being at the level that they are, the government spending, the stock markets, and so on. This decline is driven by economic growth, financial development, demographics, and many other factors. I think my personal opinion is that despite all these four arguments on the top, it's too early to say that we have seen the reversal of this trend. But again, if we continue with the fragmentation of the world market and with government deficits, then maybe it will become more serious. I wanted to put this here because very often we try to predict the effect of tariffs, of interest rates, of fiscal policy for the next 5 months, 6 months, 1 year, and so on. And very often we ignore big signs of something really terrible that can happen. I think that to me, and I think that many other people have talking about this now more and more, is the financial instability coming from excessive government debt in advanced economies. And it's not only the US, you know, that Europe is now committed to spending, 3%, 3.5% on military, plus building infrastructure, for basically stimulating the economy through fiscal policy. Now, the natural rate of interest determines monetary policy. It's very important. Fiscal space for governments, bond valuation, stock market valuation, it basically plays a very important role because it links the present with the future. This is the price that will make you decide, do I consume today or in the future? And that's what this interest rate is doing for all the. So I think that that's all. I have other slides if you have questions on them, but I'll finish here. Questions? Yes.
I also didn't mention the quantitative easing at all. So I noticed you didn't mention the quantitative easing part, and there's a huge increase in M2, M3, and M4 because of that for decades. And this destabilized interest rates, it's everything that you showed. So I just understand why it's not a relevant factor.
So basically, when QE happened, it reduced some of the interest rates. That is true. It reduced interest rates in the long end because they had, especially in QE2 and QE3, they started buying specific treasury bonds in the long end of the yield curve, and it reduced it. I mean, again, it's part of the chart where I was showing who owes U.S. government debt, so who is buying it. In this case, it was not the Chinese, it was the U.S. government, the Fed that was buying it. But beyond that, again, we can talk about whether quantitative easing was good, bad, QE1, QE2, but I don't think that for this long-term trend, it had a very big effect. It probably pushed it down a little bit more, definitely had, but to me, the big forces, because it's a temporary one, the big forces that are still there are growth in the emerging markets and demographics. Questions?
About the Brazilian case, Brazil has a very high interest rate, has had since ever. Where do we, I mean, why haven't we yet exploded? Is it high inflation? It's not really growth, at least not in the last 20 or so years. Have you seen have you studied Brazil with very high interest rates for a very long time, and why we're still here speaking with you?
So there are two components. So understanding trade deficits, I have really wonderful slides that I'll skip. The inconsistencies in statements and so on. Okay, here is Brazil. So this is what I managed to get in terms of the real rate on government securities. That is the interest rate on government securities minus, I use the GDP deflator, so inflation. Measured inflation. Okay. And indeed, it was kind of like almost about 5%, which is high for government securities. It went down during COVID, and now it has gone up again, about 5, 6, 7%. So there are two questions because there's the private markets and there are the government. For this thing, in my view, if there are free capital flows, which by and large, I think for this thing there are, you can easily buy this thing, so on abroad. The only explanation that I have is risk premium. But again, we're not talking about the private lending, which we discussed before, where it's 20, 30, 40% interest rates, which is crazy. So for the private credit, the answers could be quite different, like lack of competition, lack of the inflows. For the government and the overall the economy, to me, from my view, the explanation is the following. Foreign investors are supposed to arbitrage any differences. I look at Brazil and I say, you know what? I can get here a real return of, let's say, 5%. In most of the other countries, I get a real return of 1%. So that's a great arbitrage opportunity. However, I looked then at Brazil and I realized that the average inflation rate from 2000, so you know why we're ignoring the previous periods, was 7.5%. Inflation differential with the US is 5.2%. So obviously in the US, inflation was about 2.2 or so. There is something very simple that I have written here, but I'll write it again. The depreciation of the currency in the long run is equal to the inflation in Brazil minus inflation in the US.
Should be.
It should be, right? So let's see why it works. Inflation differential with the US 5.2, depreciation 5.38. Well, not exactly, but I compare this to Australia because they also have minerals and so on. But the advanced economy, of course. Well, there's the gap is a little bit different. The inflation differential is 0.87, but the depreciation is 0.3. But still not bad in terms of the overall. Now, the other thing that matters here is that, so here, the red line is the inflation differential. This is the average of 5.2. Okay? And you can see that's pretty stable, but still it fluctuates much more than in Australia. And this is the currency depreciation. So when I look at the standard deviation, that is the volatility, 2.6, what it tells me is that inflation in Brazil with 95% probability will be between 2.5 and 12.5. I just add 5 percentage points on this. As a foreign investor, I know this, and I know that if in Brazil there is inflation of 12%, then the currency will depreciate at some point by 12%, and I will lose a lot. So this interest rate differential is not interesting to me. So you have a risk premium, in my view, that is due to inflation and inflationary expectations. And again, recently, obviously, Brazil had inflation. And now when you see the real interest rate is increasing on the government bonds, it's increasing because, again, there's more risk. It's not about Brazil at all. It's for every country. So we can ask the question, why the US had 6-7% real rate that started going down in the 1980s. Because in the 1970s, the US had very high inflation that was surprise inflation. So everybody who was holding government bonds lost because they're nominal. And if you lose, the next time somebody offers you government bonds, you say, I want high return. So that's why returns increased and they started going down. So when you look again back at this chart, there was obviously a lot of credibility going into government somehow over here. And then after this inflationary episode, then you have the thing that it will be high interest rate. To me, so because I looked at articles, about Brazil, high interest rates and so on, people look at savings rate, at investment and so on. But if you want to know one thing about finance, it's about arbitrage. There's nothing else. I mean, people have huge courses on asset pricing, get Nobel Prize, but there is one thing: arbitrage. Options are priced because of arbitrage. Interest rates, everything, arbitrage. So if you tell me that I have a great return in Brazil, I don't care about your savings rate. I don't care about your investment rate. I just come and invest here up to the risk premium. So there are two reasons that it could be high. Either the market is segmented, and then the savings rate and all these things matter, or if the market is not segmented, then you have the risk premium. For the private sector, again, I think it's a different explanation because I think competition and all these things will change, the interest rates for private individuals. But yeah, I think that that's my explanation. That I don't know whether we have any time more. I don't want to keep people until like 2 a.m.
Do you have any question? It's online. No?
Everything is crystal clear.
Crystal clear and easy.
It's very easy. It's like, I use only subtraction and addition. No, actually, I had this discount formula, but it's from your MBA class, the present discount.
Although what I said we wouldn't speak about tariffs, would you speak a few minutes or a few seconds about it?
So to me, if you want to understand what is happening, there are two things. I'll just put them up. I'm not going to go through all these slides because they're too complicated, but for 2 seconds. But there are two identities. So that's not a theory, right? So we're not talking about theories. There are two identities that you need to know. This identity basically says that the current account deficit or net exports, the trade balance, is the difference between savings and investment. Not exchange rates, nothing like that. Saving and investment. It's an identity because if you look at the standard, if you remember the standard GDP formula, okay, this is output is 4 piles of goods: consumption goods, investment goods, government purchases, and exports. It's not exports because from consumption we have to subtract imports, from investment we have to subtract imports, so it's negative there. So Y minus C minus G minus I is equal to net exports. I've taken everything on the other side except net exports. But this is the definition of savings. Saving is the income that we have generated and the private sector or the government sector does not consume. I mean, you have to add taxes, but you add it on one side, you subtract it from the other side and all these things. So roughly speaking, it basically says that the following simple thing. If we consume more and save less than what we produce, where do we get these goods from? The rest of the world. If we have produced more, if our production, Y, exceeds the domestic absorption, meaning exceeds our consumption, government spending, investment, where are these goods? They must have been exported. So that's an identity. There is no way around it. The good thing is that now we know what drives savings and what drives investment. And at no point in time, I mentioned the exchange rate as a driver of saving or investment. So changes in exchange rates, they can have an effect, but you have to create the story how it will have an effect on saving or investment. It's a bit complicated. So putting tariffs on these things may change saving and investment in the following way. Tariffs increase prices of goods and services, right? Because they're more expensive. If they increase the price of goods and services, people consume less. And if they consume less, they also generate less income for the economy. In fact, here is, actually, that's a really good chart. So just to see, here is the US current account deficit, which by the way started in the 1980s. It's not true that the US has always been running current account deficit or trade deficit. It started with Reagan and huge budget deficits, meaning a lot of absorption. These goods were coming from the rest of the world. When is the US running surpluses? In the recession. Another recession here, not all the way to a surplus, but big improvement. So the only way that through tariffs you can generate current account improvement is by actually getting a recession. Otherwise, it's not going to work. Not only this, but now look at this thing. The second accounting identity is saying that whatever we trade in goods and services has to be matched in trading assets. The US is running a 2 trillion deficit. They're not getting these goods for free. They have to give something to the rest of the world, and they give them assets. So, I mean, again, it is an identity. Here, exports, imports, the balance on the current account is matched by Americans buying foreign assets. So they buy foreign assets, but they sell much more to foreigners. 1.1 trillion or 1.2 trillion. So this is a very important thing because the moment you say you eliminate this, because Trump said we're going to get rid of the current account, the trade deficit, you eliminate this. It's not possible to have here something positive and here something negative. But they're utterly inconsistent in these statements because when you buy more goods from abroad, you're selling dollars. You're giving them dollars, right? So I buy, from China, I have to pay in dollars. When I invest, when Apple builds a factory in India, they pay dollars. So this is the supply of dollars from the US to the rest of the world. Foreigners take these dollars, they invest them back in the US. I mean, they can keep them, but that also counts as investment, right? Dollars flowing into the US. So now, Trump says that tariffs will stay until trade deficit disappears. Then on CNN, he says, I talked to Tim Cook, he's a good friend, and he said that he's not going to invest in India because he was saying that Apple is not going to produce in China, but in India, which means that this goes to zero. This is reduced, let's say to 500 billion, sorry. And then Treasury Secretary Bessent says that the United States will be the best destination for international capital. In fact, the European agreement, I don't know how many of you read the tariff agreement with Europe, was asking for a big investment of Europeans in the United States. So let's do simple arithmetics. I mean, it's not even high school. What happens if the supply of dollars goes down from 2 trillion to, let's say, 500 trillion? This is 0, this goes down to 500. Okay, so these are the suppliers of those on the international markets. But here, from 2 trillion, we want to go higher. You know, Europeans to invest and everybody else. 2.5 trillion. You supply 500 billion, 0.5, you demand 2.5. What happens? Well, inflation may happen, but there's something else, you know, the exchange rate. So people say, I need dollars because I need to invest in the United States. The demand for dollars goes up, the exchange rate appreciates. Normally with appreciation of the exchange rate, slowly, again, you have the mechanism through savings and so on, the trade deficit again increases. So you cannot have these 3 statements together. It doesn't work. So the reason I'm showing you this is not to point out to, you know, simple arithmetical mistakes, but to say that I don't believe that the trade deficit will be closed next year, or the year after, or the year after.
Forever.
Forever, yeah, unless there is a recession. So when you have consumption going down, then because there is less consumption, you can actually get, as we saw before, that a trade surplus. But I mean, again, this is very disruptive. I think it will be bad for the world economy. I mean, I know that Brazil is now in the eye of the storm with all this. But in my view, what is really happening is that we can see the shift of trading partners. So the blue ones are trading more than 50% with the US. Oh, sorry, more with the US than China. The red ones more with China in 1989. I don't know what Denmark was doing at the time. I still have to find out. This is today. So, in my view, what will happen? A lot of trade flows will be reoriented. And as the US is fighting with everybody else will be getting together and building new trade flows. If I was Xi Jinping, I'll use this opportunity to make the yuan the international reserve currency. But you know, they're not brave enough because they're missing one very important thing for international reserve currency. The big thing that they're missing is free capital flows. So because you know, if you have restrictions and all these things, it cannot be a reserve currency. But the moment they say, you know, just use the yuan in the same way that we're using dollars, and you have the same flows and so on, a lot of trade will start, and with the stability that they can afford and they can offer, a lot of trade, especially here, will start in yuan, but also then here, and maybe even here.
And why not the euro?
The euro, actually, that's another option.
The European Union is a larger market to us, if you count all the countries together, than the US.
That is true, but I think that, and I think that Europeans also have a huge opportunity. It's just that they cannot decide who is the leader.
Yeah. Yes.
And I think that that's a big issue. If they have a leader who will say now, look, you know, this is what we're doing, they can do it. But the markets are fragmented. You know, their financial markets are just ridiculous compared to the US financial market. And you need the debt. The debt is very small. You need to have the reserve currency with a lot of bonds that are behind it so that you can do this trade. And they're still very small. But again, slowly they can start chipping away because, and today, before coming here, I saw on CNBC that they're considering this guy, David Zervos, I think it's the one guy from investment banker is considered for the next chairman of the Fed. And I've listened to this guy a couple of times on CNBC. I think I'll convert all my dollars to reals. the next, because, he was saying we just have to cut interest rates. So it will be interesting to see how all of this is changing. Euro is an option, but I think that China has the ability to put the act together if they're willing to take the risk. If they're not taking it, that's not going to happen. So how do you feel about Brazil these days?
I'm bullish with election next year.
Well, actually, Brazilians are optimistic by nature. It's a major difference from some other peoples, But it's hard, It's more hope than experience.
But I don't know, I'm just curious what you think is the issue. It's like fiscal deficit. I'm just curious. I want to learn. So I hope you've learned something from me. I want to learn from you.
Fiscal and also productivity, education.
Yeah.
We don't have
The short term, the long term problem is
productivity. We are not improving productivity for a long time.
But the question is why? Productivity is an endogenous variable.
The economy is very closed. That's maybe a good thing that will happen after the Trump shock.
Sure.
It will open up the market.
Great opportunity that open the market.
Yeah.
Open the
And the exchange rate is super high, so it's hard to import stuff and you develop high competing industries.
Yeah.
So you depend on commodities.
Yeah, I think that actually, maybe, this is the Dutch disease, right? So the Dutch disease is basically if you have commodities produced, then because people buy your commodities, they buy your currency, and then your currency appreciates, and then it kills a lot of the other industries. I mean, I don't know. I was surprised to see in the World Bank that the quality of institutions in Brazil is actually going down. The quality of institutions. So the institutions that we usually look at are rule of law, control of corruption, democracy, political stability, and so on.
With relativity, Brazil is amazing compared to the US or other places. Like we're very, very better than everybody else.
Everywhere is going down. Everywhere is going down now.
Yeah, well, that is true. That is true. But that this year the people who received the Nobel Prize basically said that institutions are the most important determinant of economic development. And in fact, usually the lecture that I give every time that people ask me to give a lecture is about the middle income trap and the economic development in institutions. And basically, Brazil has been at the same level relative to the US for the last 40 years.
But then if you look at the institutions in Northern Europe, Scandinavian countries, fantastic in terms of institutions. Yeah. And then you look at the economies, the growth, and it's not there.
I think that actually a lot of these countries are doing really, really well. I mean, Denmark is one of the most vibrant economies in the world. I mean, Novo Nordisk, Novozymes, tons of other, Lego. It's I mean, Lego is a fantastic company. It's just one of the fastest growing companies in the last 20 years. So they're doing really well. In fact, a lot of people say, how come with these high taxes, there's still so much innovation in Sweden, in Norway, in Estonia, so
Finland.
Yeah, I mean, again, I don't know enough about Brazil to tell you, what are the institutions here, but I know one thing that, I have this, let me just show you this chart and then we finish because it's also my wife.
It's 2 a.m. in Bulgaria.
It's 2 a.m. in Bulgaria, but as you can see, I'm very angry. So this is the chart that I spent a lot of time talking about. Basically, institutions, you can read the institutions out there, I'm not going to repeat them. They're from minus 2.5 to plus 2.5, six institutions, I've averaged them. So this is the average. This income per capita in 2019. Now, what is really shocking about this chart is that there is nobody here. There is not a single poor country. So these are 4 countries here. These are rich, it's a logarithmic scale, it doesn't matter. So not a single poor country that has good quality institutions. Similarly, what you can see here on the other side, nobody here. Not a single rich country with 4 quality institutions. So the interesting part is that in this area, it's more like a cloud. In other words, I can have the institutions of Mozambique, but somehow if I do something right with the same institutions, I can have the same income as Belarusia. Okay, which is basically, here we're talking about something like $30,000. Here we're talking about $2,000. So here you don't have to improve your institutions, but there is a wall. So basically, I created this chart in 2007. I call it the Great Wall because of China, because China was sitting here and was growing very rapidly. One of my students said, we talk about the institutions, but why is China growing so fast? So then I created this chart and I realized that China was here where institutional quality can be maintained, not be improved. It has reached the gray area. So now it's in the wall area here.
Professor, what is the causation? Because is it growth that lead us to have great institutions, or because we have great institutions that we?
So that's a great question. Let's see. Once you reach here, once you reach the wall area, which is the middle income threshold now, countries have 2 options. There are countries, again, here see Romania and other countries that have changed institutions and are going up. And here the relationship is very close. Others do not change institutions. And then they get stuck here for 40 years. So it's not, proving causation is very difficult, but just look at the correlation. I don't see a rich country here. You cannot say that Argentina, Brazil, China will become a rich country unless they reform and they start going up. So, again, I spend a lot of time on these things, and some people say, well, you know what? It's actually different with China. This is, by the way, the trajectory of China from 1996 until 2019. You can see, basically not changing institutions almost at all. But, when I talk about these, people say, well, China is different because it started here. It's been moving to the right. We don't know what they do, but they know what they do. They'll figure it out and they'll go through your stupid wall and become a rich country with these corporate institutions. Maybe. But it's worth remembering that the Soviet Union collapsed exactly here. The Soviet Union was growing at very high speed in the 50s and the 60s. They stagnated with a centrally planned economy. They were growing faster than the US and everybody else. So to me, this is Brazil. And Brazil has been relative to the US for the last 40 years. And I can show you the previous slide. And to me, if this is not changed, growth at 2.5%, which is the projected growth by the IMF, will basically keep Brazil at the same level relative to the US as in the past. Yeah.
On one side, you say that China might become the fiat currency if it adopts the free cash flow, the free currency flow, free market flow. On the other hand, they are reaching the wall.
Yeah.
It's just like that. If they adopt the free financial markets, they can become the fiat currency, and then that's it. They are there, and then because this gives huge advantage.
It's definitely one of the institutions. They call it the quality of regulation and so on. But it is definitely one of the institutions that they need to improve. But I agree with you. It's a bigger question than this. You need to do rule of law, all these things in order for China to become the reserve currency. But they can do this because a lot of people say, oh, but voice and accountability is basically democracy. So they're not going to give up control, the Communist Party. But guess what?
Singapore is there, right?
Exactly.
Yeah.
That's an amazing point because look at this, Singapore is all the way up here. And on democracy, Singapore is at 38th percentile. Only 38% of the countries in the world have lower reading than Singapore in democracy. But on everything else, they're at 99th percentile.
But I don't see the corruption change in China or the lack of rule of law. Like it's another world. It's generation and only works because the PCC is there.
No, but again, you see that China is having problems now. My view is not that China cannot grow, but my view is that China, without changing these things, cannot become a rich country. Without changing it, it will be, maybe it will go a little bit on the other side and so on, like Brazil, you know. So here is, if you want to see it. This is GDP relative to the US. So the US is at 100. Brazil growing very rapidly, reaching almost 40%. So going on the other side of the wall.
Look, coming back.
And then since 1980s, so if you ask me what needs to be done, it is this before anything else. And it's not easy. It's not like, it's not an easy thing to do, but and you can see China. But again, China has just reached the level of Brazil. And again, with the same quality of institutions, I think China can easily also start spending. Okay, I think that I have, went well over time, and thank you very much for your patience here.